Trend lines and channels. In this video, you will learn: what are trend lines? What are price channels? The linear regression channel, different trend line degrees, and speed lines. Trend lines are an important tool in technical analysis. Since technical analysis is built on the assumption that prices trend, they can be used to help identify and confirm a trend. They can also be used to signal when a trend is changing. An uptrend line has a positive slope and is formed by connecting two or more bottoms and extends into the future to act as a line of support. 2 points make a tentative trend line, while 3 or more make a valid line. The more it has been tested and the longer it remains intact, the bigger the significance of the trend line. A downtrend line has a negative slope and is formed by connecting 2 or more tops. 2 points make a tentative trend line, while 3 or more make a valid line. The more it has been tested and the longer it remains intact, the bigger the significance of the trend line. The steepness or slope of a trend line is very important. A trend line that is too steep indicates that the rate of the ascend is not sustainable. A trend line that is too flat indicates that the uptrend is weak and may not hold. Most valid and sustainable trends show a slope of 45 degrees. In the case of an uptrend, as long as prices remain above the trend line, the uptrend is considered solid and intact. A break below the uptrend line indicates weakness in the uptrend. A close below the trend line is more significant than just an intraday penetration. Certain filters can be used to confirm the breaking of a trend line. A price filter, where you wait for a certain percentage drop below the line, or a time filter, where one or more closes below are needed in order to confirm the break. In the case of a downtrend, as long as prices remain below the trend line, the downtrend is considered solid and intact. A break above the downtrend line indicates weakness in the downtrend. A close above the trend line is more significant than just an intraday penetration. As in the case of the uptrend line, we can use filters to confirm the break of the downtrend line. A price filter, where you wait for a certain percentage move above the line. Or a time filter, where one or more closes above are needed in order to confirm the break. Price and time filters are used by traders to validate the penetration of a trend line. For long-term charts, we use the 3% rule, which means that the price has to close 3% or more beyond the trend line to consider it a valid break. For short-term charts, traders would prefer to use 1% as a price filter. For Forex and commodities, we use 1% for long-term charts and 0.3% for short-term charts, as these securities are less volatile. An alternative filter is a time filter that outlines a close of 2 consecutive candles beyond the trend line to confirm the break. Trend lines can and should be adjusted when needed. Breaking of a steep trend line suggests the need of a deeper price correction. A new, slower trend line may prove to be more sustainable. In many cases, a flat uptrend line may prove to be too slow to follow the increased bullish price momentum. So a steeper trend line should be redrawn to closely track the accelerated move. The fan principle is characterized with the following behavior. After a break of an uptrend line, prices might fall for a while and then rally up to retest the trend line, which now serves as a resistance zone. A second uptrend line can be drawn through the new trough. The break of the second trend line indicates further weakness and allows the drawing of a third trend line. The breaking of the third trend line signals a valid trend reversal. After a break of a downtrend line, prices might rise for a while and then drop to retest the trend line, which serves now as a support zone. A second downtrend line can be drawn through the new peak. The break of the second trend line indicates further strength and allows the drawing of a third trend line. The breaking of the third trend line signals a valid trend reversal. In some cases, you can draw a line parallel to the uptrend line to form a bullish channel, providing boundaries within which price moves. The return line is drawn parallel to the uptrend line along the tops. The two lines form a channel, and prices are expected to continue moving up between the two parallel lines. In a downtrend, the return line is drawn parallel to the downtrend line along the bottoms, forming a bearish price channel. In this case, the prices are expected to continue moving down between the two parallel lines. An easy and more objective way to draw channels is by using the linear regression channel. This channel is based on the linear regression line, which is a statistical line that best fits all the data points of interest. To draw the linear regression channel, we always draw the line from left to right. In a downward trend, we draw it from the all-time high to the all-time low of our time frame, while in an uptrend, we draw it from the all-time low to the all-time high of our time frame. The linear regression line goes through the middle of the candles, serving as an average of the data. The upper channel line is a line that runs parallel to the linear regression line and is usually drawn 1 to 2 standard deviations above the linear regression line. The lower channel line is also parallel to the linear regression line, drawn 1 to 2 standard deviations below the linear regression line. How to use channel lines. In the case of a bullish price channel, as long as prices advance and trade within the channel, the trend is considered bullish. A break above the return line would be bullish and indicate an acceleration of the advance. The first warning of a change in trend occurs when prices fail to reach the return line. A break below the uptrend line would provide further indication of weakness in the uptrend. In the case of a bearish price channel, as long as prices decline and trade within the channel, the trend is considered bearish. The downtrend line acts as a resistance area and provides selling opportunities for traders with the direction of the trend. The return line acts as a support zone and can be used for profit taking, with a break below it indicating further weakness of the downtrend. The first warning of a change in the trend occurs when prices fail to reach the return line. A break above the downtrend line would provide further indication of weakness in the downtrend. Trend lines of different degrees can sometimes be drawn on a single chart. Major trend lines, intermediate trend lines, and even short-term trend lines. Another technique of finding trend lines are speed lines. To calculate the speed lines in a trend, we start by measuring the vertical distance of the move between the all-time low and the all-time high, in our example, 1,200 units. The first speed line is drawn at 2/3 of this distance, that is, 800 units from the all-time low landing at 1,800. The second line is drawn at 1/3 of the distance, that is, 400 units from the all-time low landing at 1,400. Speed lines measure the rate of ascent or descent of a trend, or in other words, the speed. The main use of these lines is to detect possible supports and resistances within the trend. Note that since speed lines are drawn by connecting the beginning of the trend with the 2/3 and 1/3 of the vertical distance, it is not unusual for them to run through the price action. In our next video, we will talk about supports and resistances. Thank you for watching.